How do you avoid taxes when rebalancing your investments? How can you rebalance your investment portfolio in less than 5 minutes? And why do lenders see a different credit score than the scores provided to us by the credit bureaus? We'll answer these questions and more on this, the 52nd episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 52nd episode of the DoughRoller podcast. I'm Rob Berger, and we've got a good show for you today. We've got a money tool of the day and a money tip of the day that are related. We'll get to the money tip of the day at the end of the podcast, but let me start with the money tool of the day, and that is a way to get your official FICO score, and the way to do it is at MyFICO. And this will come back to this at the end of the podcast. You'll see why I've made this the money tool of the day, but I've used MyFICO before. So here's the deal. You do have to pay for it. They offer a first month special, if you will, where for $4.95 for the first month, you can get access to your official FICO score. And then you can continue their service if you want, or you can cancel it if you continue it. It's $14.95. Now, if you've been listening to this podcast or reading my blog, you know there are ways to get what are called educational scores for free from folks like Credit Karma and Credit Sesame. I think they're both terrific tools to understand your credit score, but you're not getting your FICO score. So if you want your FICO score, MyFICO is the place to go, and you can go to a page that shows this discount if you just go to DoughRoller.net/FICO, FICO, DoughRoller.net/FICO. That will redirect you to the MyFICO page where you can get the first month for $4.95. Now, we're going to come back to this at the end of the show because, as it turns out, sometimes it's very difficult to know the score, the credit score that your lender will actually see. And I'm going to explain why that is in the money tip of the day at the end of the show. So with that, let's move to the main topic for today. If you listen to podcast 51, and if you haven't, you should go listen to that podcast first. We talked about rebalancing your investment portfolio, and we talked about various strategies of how to do that. You can do it just based on time. They call it a frequency approach, where you just rebalance every 6 months or every year. You can do it based on a threshold approach, where you rebalance your investments when they get out of line by a certain percent. So, for example, if you've got a portfolio of 50% stocks and 50% bonds, and you picked a threshold of 5%, well, when your stocks hit 55%, or if your bonds hit 55% of your total portfolio, then you'd rebalance then. Of course, if your stocks go up to 55%, that means, of course, your bonds have to go down to 45%. And when that happened, you'd sell your 5% of your stocks, perhaps. We'll talk about approaches today, but you might sell 5% of your stocks and reinvest that in in bonds to get back to your 50-50 planned asset allocation. In my case, I use both frequency and threshold. So I rebalance on a monthly basis, or I review my investments on a monthly basis to see if they need rebalancing. As I mentioned yesterday, that's probably more frequent than the vast majority of people want. I still think once or twice a year is fine. But then when I look at my investments each month, I take what I call a 5-25 approach. So for my big asset classes, stocks versus bonds, U.S. stocks versus foreign stocks, I look to see if they've moved by 5%. So again, my stock to bond allocation is 80% stocks, 20% bonds. So if that moves by more than 5%, my stocks go up to 85% or down to 75%, I'll rebalance. And the 25 rule that I follow comes with certain asset classes where I don't have much invested. So for example, I have a commodities fund, but I only have 5% of my portfolio in it. Well, I can't use the 5% rule. I mean, it's not the commodities fund isn't going to go down to zero, and it may never go up to 10% of my total portfolio, even if there's a bull market in commodities. So instead, for those smaller asset classes, and that might include, again, commodities, maybe you have a small portion in REITs or emerging markets or small caps or whatever, I use a 25% rule. So what I do for those is I just take 25% of that portion. So for example, 10% in REITs, I would take 25% of my 10%. So 25% of 10 is 2.5. So for that 10% in REITs, I would rebalance if it went above 12.5 or below 7.5. And I do the same thing with my 5% in commodities. And let me see if I can get the math right. That would be 1.25%, right? So if my 5% dropped below 3.75 or above 6.25, I would rebalance. So that's my approach. If you have a simpler asset allocation plan where maybe you've only got U.S. stocks, bonds, and maybe some foreign stocks, a 3-fund portfolio, rebalancing for you is going to be a lot easier. But for those that maybe have multiple asset classes like I do with emerging markets, REITs, small caps, commodities, I think you need to look at maybe a hybrid approach like I've just described. Again, the 5% and the 25% aren't really the important numbers. If you have a 4% threshold instead of 5 or a 6% threshold, that's fine. The 525 is just what I use. So once you have your strategy in place, whatever that is for you, now what we're going to look at today is how do you actually do it? How do you actually go about rebalancing your portfolio? Maybe, again, you're doing it on a frequency basis, a threshold basis, maybe both. Fine, but you've checked your investments, and yes, you need to rebalance. How do you actually do it? And we're going to look at two things today, the factors that really should go into answering that question, and then I'm going to give you some specific options as to how you might go about it. So let's start with the factors, and there are 4. One is simply the complexity. As you start to save for retirement, and you may have a 401k, you may have multiple 401ks, you may have one or more IRAs, you may have money invested in taxable accounts. Then you may have a spouse, and he or she may have 401ks and IRAs, and so all of this can get a bit complex as you're trying to have an asset allocation that spans all of these accounts, and then trying to rebalance them. And so, in looking at the ways in which you can do rebalancing, I do think simpler is better. And if we can avoid the complexities, and there are ways that we can, we'll discuss those specific options. But I think that's one factor to think about, is just how complex your investments are, and if we can find simple ways to rebalance a portfolio. And so that's the first factor. Second factor, of course, is taxes. If you have money invested in taxable accounts, selling investments may very well trigger a capital gains tax, and we have to be very mindful of that. And I think in the vast majority of cases, you should be able to rebalance your investments without triggering taxes. Now, there could be some exceptions to that, certainly. But I think for the majority of us, we should be able to avoid the taxes. And I know in our case, we have significant investments in taxable accounts, outside of our 401ks and IRAs, and we've been able, by and large, to avoid triggering any capital gains taxes when we rebalance. But that's the second factor, very, very important. The third factor is costs, and again, this hits folks primarily in taxable accounts. With a 401k, you can typically buy and sell funds within your 401k without any cost. Now, you don't want to assume that. You want to make sure that the funds you're buying into don't have any costs when you sell or when you buy. But at least in my experience with 401ks, that's not been the case. There have been no costs. And with my IRAs at Vanguard, I can buy and sell Vanguard mutual funds and ETFs generally without any costs. Sometimes funds actually will charge you costs when you buy or sell that actually go back into the fund itself. So in other words, the mutual fund company isn't profiting from this. The money is going back into the very mutual fund that you own, but they do that to avoid folks doing a lot of short-term buying and selling. So there could be costs, even with a Vanguard type fund, that you want to make sure you're aware of. But on the taxable side, if you're investing in individual stocks and ETFs, there are going to be brokerage fees, for example. And depending on how complex your investments are and how many different stocks and ETFs you own that may need to be part of this rebalancing, the costs could be significant. So that's the third factor we want to keep in mind, are the costs. And the fourth factor is a particular issue with 401ks, and that's simply fund options. I don't know about your 401ks. At different times, I've had 401ks that I thought offered some great investing options, and then in some cases, not very many at all. And so if you have a 401k where you only think you've got one good option, and that's happened to me, where the one good option I had was an S&P 500 index fund, and all the other options were very expensive funds. Well, if I need to rebalance within my 401k, where's the money going to go? Sure, I can sell shares of the S&P 500 index fund that I own, but where am I going to now put it? If I have to rebalance into a bond fund, for example, or maybe a foreign a stock fund within my 401k, I'm going to be left investing in very expensive mutual funds. So that can be a factor. Again, I think it's generally with 401ks, because in an IRA, you can open your IRA just about wherever you want, and whether it's at a brokerage firm or a mutual fund company like Vanguard, or a firm like Betterment, which is a bit different, but I think if you've been following the podcast, you're familiar with Betterment. But at a place like Vanguard or a brokerage, you can invest in stocks, bonds, ETFs, mutual funds. So you have a lot of options. But within your 401k, you may be limited. And I think that has to be a factor as you think about how you're going to rebalance and within which accounts you're going to rebalance. Because again, the asset allocation is across all of your accounts. And but when you rebalance, you may not need to make let me try that again. You may not need to make changes within each of those accounts. You might be able to rebalance by making changes within, say, just your IRA. So fund options can be a difficult issue, again, within 401ks. So that's the fourth and final factor I think you need to give some thought to when it comes down to actually rebalancing your portfolio. So with that, let's move to the second part of this, and that is, what are the options? So I'm going to give you 5 of them. The fifth one's kind of an oddball, but we'll get to that in a minute. But let's start with the first one. And this is I'm giving these to you in the order that I go through them myself. So I start with option 1, and hopefully I can rebalance just with option 1. I don't even get to options 2 through 5. So these are in a particular order. And the first one is the easiest one, and it's how I mentioned at the beginning of the show. The question was, how can you rebalance your portfolio in less than 5 minutes? And this is how you do it, and that is you rebalance by simply redirecting future contributions. So, for example, in 2013, there was a big run-up, as we all know, in stocks. The S&P 500 was up 32%. So for most of us, we probably need to rebalance by selling or moving our investments from some stock funds into some bond funds. Well, the first way I do that is to simply set my future contribution. So, for example, in 2014, all of my contributions to my 401k are going to a bond fund. And so that avoids any taxes, it avoids any costs, and it's very, very simple. I can log into my 401k and change my future contributions. Literally, I said in less than 5 minutes. I should have said less than 60 seconds. I mean, it really doesn't take long at all. And now all of my 401k contributions in 2014 are going to a Vanguard bond fund that's available to me in my 401k. Now, something to think about there. That kind of approach to rebalancing, of course, doesn't just happen immediately. It's going to now take me some time to get back into line with my target asset allocation plan, because I'm only contributing, a relatively small amount to my 401k each month. Although over the course of the year, it should be enough to get my portfolio back in line with my target asset allocation. And I'm okay with that. I'm fine if it takes several months, 6 months, or even a year, as I slowly, make these contributions and slowly get my asset allocation back in line with my plan. I'm fine with that. Given the convenience, no taxes, no costs, very, very easy to do. I'm fine with that approach for me. And so that's the first thing I look at. Can I rebalance my portfolio with future contributions? And by the way, the same could be true if you contribute to an IRA. Same thing. You make say monthly contributions to a taxable account. Same approach. Well, whether the future contributions are to a 401k doesn't matter. That just is, for me, where most of my contributions will go this year. That and at the end of the year, eventually a SEP IRA. So look at whether you can change your future contributions to affect your rebalancing. That's the first option in my view. The second thing I look at is rebalancing just within retirement accounts. So if I'm, for whatever reason, if future contributions won't be enough to rebalance my portfolio in a reasonable amount of time, or maybe I'm not contributing at the moment to retirement accounts or other investments, then I look to see, can I rebalance just within my retirement accounts, 401ks and IRAs? Because if, again, this goes back to the taxes and costs. Since it's in a tax deferred account, I'm not going to trigger any capital gains taxes if I say sell 5% of my stock mutual fund to buy 5% of a bond fund. There won't be any taxes. And then again, in most cases, there won't be any costs or they won't be significant. Again, you don't want to assume that. You need to check that out in your specific situation. But if future contributions aren't enough, I look to rebalance just within my retirement accounts to avoid the taxes and the costs. Then the third approach, the third option, and this again after I've sort of exhausted options 1 and 2, and this focuses more on taxable accounts, but is I can rebalance by redirecting interest payments from bond funds and dividends from stock and stock funds. So what you probably do is you automatically reinvest all of this into your funds. Reinvesting dividends, for example, is very common, where your mutual fund or individual stocks declare dividends, they're paid out, and then just automatically reinvested. But that doesn't have to be the case. You don't have to reinvest your dividends from your stock mutual funds or your individual stocks. You could have those swept into a cash account associated with your mutual fund or your brokerage account. And the same could be true with interest payments from bond funds. Now, in a taxable account, all of these interest and dividends are taxable events, even if they are reinvested, right? So depending on your tax situation, you'll likely have to pay taxes on these amounts, again, whether they're reinvested or not. So you've already been hit with the taxes. So given that, to rebalance, you could have those, rather than reinvested, swept into, usually in my case at Vanguard, it's a money market account. And then you could redirect that money into whatever investment you needed to effectuate the rebalancing of your portfolio. So that's sort of a third option. Now, that's where the complexity starts to ratchet up a little bit, right? Because you've got to change from automatically reinvesting this money to having it moved into a money market account, and then you've got to go in and figure out where you want to invest it and make sure you do that. So this definitely involves a lot more work. Hopefully you can rebalance with options 1 and 2, but this is a third option that I wanted to mention to you. Again, since these are already taxable events when the dividends are paid and the interest is paid. If you need to, why not use that money to rebalance rather than selling investments in a taxable account that could trigger capital gains? That's the third option. The fourth option is, of course, now we're down to rebalancing within taxable accounts as sort of a last resort, and actually having to sell investments and buy other investments to rebalance. This really is an option of last resort. I don't think, thinking back over the 20 plus years I've invested, I don't think I've ever had to do this. But if I had to, the first thing I would look at is, do I have assets that have maybe they're at a loss right now, so if I sold them, I'd actually get a tax benefit. I could report that loss on my returns, or that have very little gains, where, there's going to be some capital gains, but pretty minor. That would be one thing to look at. The other thing to look at is to make sure and understand whether the gains on the investments you might sell, are they short-term gains taxed at ordinary income rates, or are they long-term gains from investments you've held for more than 12 months, that you're going to get the capital gains treatment. That's another thing to look at. And keep in mind that with stocks and stock mutual funds, you may have on an investment both short-term gains and long-term gains. So this gets even further, complicated and involved. Again, I think this is something that you should be able to avoid doing when rebalancing your investments. But if you have to do it, consider those factors. Look for investments that are perhaps at a loss or that have little gain, and make sure you understand what type of gains there are, short-term versus long-term. Okay, the fifth option, which I mentioned, is kind of really doesn't fit within the first four. And it's actually an option that I think can help you not only make rebalancing a little easier, but it can also make the asset allocation plan that you develop and executing that a little easier. And here's the deal. And I actually had a friend of mine mention this to me, I've had this very same experience where, for whatever reason, you may have a 401k or an IRA with relatively little money in it, and that you're not adding to it. I have this. I have a rollover Roth IRA that came from a Roth 401k that I had at a previous employer. And I can't add to it, so it's just sitting there, and it's about $2,000 or $3,000. So relative to retirement investing and savings, it's not a whole lot of money. And so you're sitting there thinking, well, okay, now I got to figure out how to incorporate this relatively small amount of money into my asset allocation plan, and then what do I do with it when I'm rebalancing? Where do I put it? And it's kind of a pain. And so what I've done is for that fund, that account, I should say, I've invested it in this is in Vanguard, a target date retirement fund that is automatically allocated across stocks and bonds. I have it in the 2030 fund because, let's see here, I'll be about 65 in 2030, God willing. So I have it in a 2030 fund. It's immediately diversified across stocks and bonds. The fund automatically rebalances, so I don't have to worry about it. I don't have to worry about it from an asset allocation perspective. I don't have to worry about it from a rebalancing perspective. It's a small account, and by doing that, I kind of almost put it out of my mind. I don't have to worry about it, and so that's sort of a fifth, not so much I suppose an option, but just a tip as a way to deal with if you have these small dollar accounts, again, small dollar relative to your total investments, whatever they may be. That's a way to not only make the asset allocation plan easier to deal with, but also then you can kind of just ignore it when it comes to rebalancing, because that fund is rebalanced automatically by Vanguard or wherever you have your investments. So those are the options, kind of how I think through rebalancing. Frankly, when you do this for the first time, it may be a little hard to wrap your mind around it. But I think once you do, you'll get the hang of it. Again, I would do everything possible to stick with the first two options: future contributions, one, and then two, rebalancing within retirement accounts. Use that fifth option if you have small accounts with relatively small dollars in them, to just kind of set it and forget it. You can just ignore it then, and it rebalances itself. And I think for the vast majority of people, those options should get the job done. So there you go. If you have any questions at all about rebalancing your portfolio, shoot me an email at dr@DoughRoller.net. Okay, now for the money tip of the day, and it comes from a reader named Desire, and this is her email to me. She says, "It was with pleasure that I read these articles. I have one question regarding the credit scores. I checked my credit scores with the 3 credit bureaus, and I was happy to see that my scores were all up, well above 600 for each of the bureaus. Then when I went to my credit union, to my big surprise, the manager, after checking my scores based on their system, they were it was well below what I saw with the bureaus. She told me the credit score we as consumers see with the bureaus is always higher than what lenders such as credit unions and banks see. My question for you is this: is this really true? If so, how can we as consumers get our real credit score before going to the lender? Thank you for your time. I hope to hear from you soon." Now, I responded to her email already, but I thought it was a very good question, and I wanted to discuss it briefly here on the podcast. So what's going on? So first of all, let's think about credit scores generally. How are they calculated? So you need two things to calculate a credit score. You need data, and you need a formula. So the data comes from the credit bureaus, and there are 3 major credit bureaus: TransUnion, Experian, and Equifax. And so that's where the data comes from. And the formula, probably the most widely recognized formula, comes from FICO. All right, so we need those two things to generate a credit score. So here's where the problem comes in. First of all, there's actually 2 problems. As I mentioned, there are 3 credit bureaus. The information they have on your credit is going to typically be different. It's going to, for the most part, be the same, but there can be differences in the information they have on you. And why is that? Well, you may have a car loan or a bank loan that doesn't report to all 3 credit bureaus. Maybe it only reports to one of them or 2 of them. So they'll have that information. but the other one or two won't. And so it's not uncommon if you were to check your credit report for each of these three major credit bureaus to see differences. So the data is different. So even if we were dealing with the same formula, you're going to have different data from each of the credit bureaus, and that's going to result in different credit scores. That's the first hurdle, or first reason why we see differences in credit scores. The second one, actually, I think is more of a problem, and that is that there are many different credit scoring formulas. Now, even within FICO, which you've probably heard of, there are different FICO formulas. And you say, well, why is that? Well, a couple of reasons. One is FICO is, as you would expect, constantly tinkering with their credit scoring formula to try to get the best formula they can that is the most predictive of credit risk. So they are continually adjusting their credit formula. And different lenders use then different versions of this FICO formula. Some may use the most recent version. Some may say, it's not worth the cost to change all of our systems to update it to the new FICO formula. We're fine with the old formula or one of the older formulas. So lenders can use different versions of the FICO formula. That's the first problem. The second problem is that some industries and creditors have customized versions of the FICO formula. So there could be differences there as well. And then sort of a third problem is lenders can customize it on their own. They can take into account other things, other information they may have on you in assessing and evaluating a credit score. So on top of all of that, you then have other formulas beyond FICO. Each of the credit bureaus has developed their own formulas. And so there are multiple formulas to generate a credit score, even if we were looking at the exact same data from the credit bureaus. And so what this leads to is you have multiple credit scores. You have credit scores based on the data from each of the three credit bureaus, and then that data goes through any number of formulas. Again, it's not just FICO versus all the rest. There are many FICO formulas. So that's why when you go to a lender, you may see a credit score that they have that's different than what you may have obtained through one of the credit bureaus or even through FICO itself. And so that's sort of, I guess, the bad news. So what's the good news? Well, the good news is that what I have found is that if you check your credit score through FICO, it's going to be reasonably close to what most lenders will see. Now, I know it's reasonably and most. You could have a lender that doesn't use the FICO score. Most do. Certainly with mortgages, they're going to use FICO. But not all of them use FICO. Again, most of them do. And while they could have a customized formula, or they could be using an older formula, if you go to DoughRoller.net/FICO, the score you will get from FICO is probably the closest thing you are likely to see when you go to a lender. Now, all of that being said, is it possible that you could check your score at FICO and then the next day go to a lender and they could pull your report and have a different score? Absolutely. Absolutely. This is not an exact science. The credit score that the lender sees could be different. Now, to the one question she asked, is it always the case that the score you get from a FICO or a Credit Karma or Credit Sesame, are those scores always going to be higher than what a lender sees? Absolutely not. That's not true. And I just know that from personal experience applying for mortgages. I've seen my credit score come back from the mortgage companies, and it was higher than what I had seen before, and some of them were lower. So there's no, it's not as if they always miss lower or higher. It could be one or the other. The final thing I'll mention here is that timing does matter. If you check your score, say in January, and then you go and apply for a loan in March, well, the scores could be different simply because there's more information on your credit file. And so when they pull your report in March, they're using the most up-to-date data available from the credit bureaus. So that's another factor to think about. So all of that being said, I do think if you were looking to find the score that is most likely to be used by most lenders, the place to go is FICO. And as I mentioned at the top of the show, you can go to DoughRoller.net/FICO, and that will redirect you to a page on the FICO website where you can check out your score if you want to. Now, I'll just conclude by saying I still think services like Credit Karma and Credit Sesame can be very, very helpful. And I've even did a study based on my own credit score as to how similar their scores were to my actual FICO score that I obtained when I applied for a mortgage. And I'll link to that article in the show notes. What I found was the scores were pretty close. And I was actually surprised at how close they were. But apart from that, these services can be helpful because they can show you what's helping your score and what's hurting your score. Even if the number itself isn't perfect, knowing what you're doing right and what you could be doing better to improve your score, particularly if you have a big purchase like buying a home or refinancing a mortgage coming up, that kind of information can be invaluable. Well, I hope you enjoyed the show. As always, you can shoot me an email at dr@DoughRoller.net. Until next time, remember, the best thing money can buy is financial freedom.